Welcome to our deep dive on the IRA contribution crisis. In this video, we will explain what happens when you exceed annual IRA contribution limits, why the IRS requires a formal removal of excess contribution rather than a simple withdrawal, and how to avoid the 6% annual excise tax on excess amounts. We will also cover when the IRS may require removing the excess from the Roth IRA first, plus the tax arbitrage decision when that rule does not apply. Finally, we will walk through practical steps to fix it quickly and correctly. Here is our agenda for today. First, we will discuss why excess IRA contributions are costly. Next, we will cover the mandatory removal rules that may eliminate your choices. Then, we will analyze the tax arbitrage decision for choosing Roth versus traditional IRA for removal. After that, we will provide a step-by-step correction process, followed by key risks, deadlines, and the forms involved. Finally, we will include quick quizzes to reinforce learning. When you exceed the annual IRA contribution limit, you have made an excess contribution. This is not solved by casually withdrawing funds. Instead, the IRS requires a formal removal of excess contribution process. If you do not correct the excess promptly, a 6% excise tax applies each year on the excess as long as it remains in the account. Therefore, immediate action is crucial. The excise tax is 6% of the excess amount, and it applies every year until you eliminate the excess. If you correct the excess by your tax filing deadline, including extensions, you can generally avoid the excise tax for that year. Correction before the deadline typically requires returning the excess plus or minus earnings as calculated by your custodian. If you miss the deadline, you usually remove only the excess contribution amount, but you still owe the 6% excise tax for the prior year. The 6% stops applying only after the excess has been removed. This flowchart starts by asking whether the taxpayer contributed to both a traditional IRA and a Roth IRA and exceeded the combined annual limit. If yes, it highlights a mandatory priority rule that requires removing the excess from the Roth IRA first. If not, it leads to the tax arbitrage decision between Roth and traditional based on the expected retirement tax rate. The diagram also warns that delaying correction leads to a 6% excise tax each year until the excess is fixed. It concludes by instructing the viewer to contact their custodian and request a return of excess contribution with earnings if before the deadline. When an investor overcontributes to both a traditional IRA and a Roth IRA, certain rules and custodial procedures may require that the excess be removed from the Roth IRA first. To implement this, contact your IRA custodian and request a return of excess contribution, which is different from a typical distribution. Act quickly, because delays may result in the 6% excise tax applying for additional years. Always confirm the specific requirements and forms with your custodian, and consult a qualified tax professional to ensure the ordering and reporting are correct for your situation. This comparison frames the tax arbitrage decision. If you expect your tax rate to be lower in retirement, removing the excess from the Roth can make sense because your traditional IRA contributions may be more tax efficient in the future. Conversely, if you expect higher tax rates in retirement, removing the excess from the traditional IRA preserves Roth growth and the benefit of future tax-free withdrawals. Ultimately, the correct choice depends on your expected future tax rate, time horizon, and overall financial plan. This timeline contrasts removing the excess from a Roth versus from a traditional IRA. On the Roth track, you may pay tax today on any earnings if corrected before the deadline, while preserving pre-tax traditional growth for the future. On the traditional track, your current year income can be affected depending on deductibility, and you preserve Roth growth for tax-free withdrawals later. The timeline also emphasizes the tax filing deadline, including extensions, and it ends with the uncertainty of future retirement tax rates, underscoring that this decision is a forecast rather than a guaranteed outcome. To correct an excess contribution, first calculate the total amount contributed across both traditional and Roth IRAs and compare it to the applicable limit. Next, contact your custodian and request a return of excess contribution. If you are correcting before the tax filing deadline, the custodian will compute the net income attributable, which represents the gains or losses associated with the excess amount, and include it in the correction. Then, choose which account the excess comes from, following any mandatory ordering rules or your tax arbitrage logic. Keep thorough documentation. Expect Forms 1099-R and 5498 to reflect the correction, and report any required earnings on your tax return. Observe the tax filing deadline, including extensions, to avoid the excise tax. If you are late, remove the excess immediately to stop the 6% from applying in future years, though you may still owe it for prior years. Finally, evaluate alternatives, such as recharacterization, and coordinate with a tax professional to ensure compliance. Quiz time. The question is, what happens if you do not fix an excess IRA contribution? The options are A. Nothing, it fixes itself next year. B. A flat 10% one-time penalty applies. C. A 6% excise tax applies each year on the excess until corrected. D. You must close your IRA entirely. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is C. A 6% excise tax applies each year on the excess until it is corrected. Acting quickly is essential to stop the recurring penalty. Here is a quick decision checklist. First, calculate the exact excess across traditional and Roth contributions. Next, determine whether a mandatory Roth first removal rule applies to your situation. Then, choose which account to remove from based on your forecasted retirement tax rate. Act swiftly to avoid additional years of the 6% excise tax. Coordinate with your custodian and a tax professional to ensure proper forms and coding. For reporting, if you correct before the deadline, include earnings or losses as computed by the custodian. If you correct after the deadline, remove the excess and be aware that the prior year excise tax may still apply. Manage risk by setting contribution alerts, rechecking eligibility and modified adjusted gross income, and documenting all steps. This table summarizes common correction options. A return of excess before the tax filing deadline typically includes the excess plus or minus earnings or losses, with earnings taxed in the year of contribution. Removing the excess after the deadline usually involves taking out only the excess amount and paying the 6% excise for prior years until it is fixed. Recharacterization allows you to treat a contribution as if it were made to a different IRA type. Reallocation can correct which account is treated as having the excess, if permitted, without changing the total contributed. This mind map centers on the excess IRA concept and expands to show contribution limits, account types, the potential mandatory Roth first rule when both accounts are involved, relevant deadlines, correction methods, tax effects and required forms, and the strategic decision regarding future tax rates. It provides a holistic checklist for diagnosing and fixing an excess contribution. Here is the second quiz question. If you expect higher tax rates in retirement, which account is generally better to remove the excess from? The options are A. Roth IRA, B. Traditional IRA, C. Neither RIT does not matter, D. Employer 401k. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is Traditional IRA. If you expect higher taxes later, preserving Roth contributions and growth can be more valuable because future Roth withdrawals are generally tax-free. The key takeaways are as follows. First, excess IRA contributions require a formal correction process, not a simple withdrawal. Second, missing the deadline can trigger a 6% excise tax each year until the excess is removed. Third, when both traditional and Roth contributions are involved, you may be required to remove the excess from the Roth first. Fourth, if that rule does not apply, choose which account to remove from based on your forecast of future tax rates. Finally, act quickly, keep careful records, and work with your custodian and a qualified tax professional. In summary, identify the excess quickly and contact your custodian. Follow the required ordering rules if applicable, and otherwise make a choice based on your tax forecast. Request a formal return of excess contribution, including earnings if you are before the deadline. File your taxes correctly using the appropriate forms and stop the 6% penalty from recurring. Finally, adjust your contribution process to prevent future mistakes. Disclaimer. This video is for educational purposes only and does not constitute tax, legal, or financial advice. Specific rules and custodial procedures can vary and may depend on your individual circumstances. Always consult your custodian and a qualified tax professional before taking action. Thank you for watching. If this video helped you, please like, share, and subscribe. Finally, tell us in the comments whether you would remove the excess from Roth or traditional, and why.